Markets have staged a rally off their June lows. This is primarily because the Fed has been hesitant with quantitative tightening. So the Fed had promised to start quantitative tightening in earnest in June, and the fact of the matter is the Fed did not reduce the size of its balance sheet at all during the month of June. After the markets have started to rally here a little bit in July, the Fed did reduce its balance sheet in the months of July slightly. We're now at $8.9 trillion balance sheet. That is down from $8.97 trillion back in April, which was the size of the balance sheet back then. So we've had modest quantitative tightening over the past 3 months, but not at the pace that the Fed had originally promised. As the markets rally, I do expect the Fed to continue its program of quantitative tightening, trying to reduce the excess liquidity in the system sloshing around and creating inflation. And as quantitative tightening takes place, that liquidity will come out of the market, out of stocks, and also probably out of bonds. Mortgages, as you know, have already had a huge move to the upside on interest rates, and that is already depressing the housing market. So that will be some follow through. The economy clearly is weakening at these levels, but interest rates currently are dominated by the Fed. Long-term rates with quantitative easing, where the Fed went in and bought all these bonds and mortgages and bloated their balance sheet from $800 billion to $8.9 trillion. That ended up reducing interest rates as the Fed set rates as opposed to the market setting rates. As the Fed does quantitative tightening and does not continue to buy these bonds and mortgages, rates are going to go up because they need to move toward market-based pricing. Market-based pricing on the 30-year Treasury would be somewhere in the neighborhood of 5%. And currently we're still well below that. So I still think interest rates are headed dramatically higher on the long end from here as quantitative tightening takes place and liquidity is removed from the system. This will clearly be a negative for stocks. And although we're in the midst of a very strong bear market rally, I would expect the market to experience further weakness as quantitative tightening drags on. The real question is, as quantitative tightening starts to impact and the economy starts to weaken and stocks most likely weaken as well, at what point will the Fed blink? I would expect the Fed to blink before it actually gets inflation under control. So I do think inflation will be a longer term problem and is definitely not transitory. This is information I hope you find helpful. Please take a look at our full disclaimer on buildingbenjamins.com, and I hope you have a great day. Thank you.